Last week, a major shift occurred in the Chinese economy. For the first time, the country's largest exchange-traded fund is no longer a stock index, but a gold ETF. This accumulation accelerated even as gold prices were dropping. When the price fell nearly 30% earlier this year, Chinese retail investors and the People's Bank of China responded by buying more, marking 20 consecutive months of central bank purchases. The metal is physically moving across borders. Export data shows the United States is currently shipping record amounts of non-monetary gold directly to China, a trend that spiked significantly in the final quarter of last year. To consolidate this physical supply, 4 of China's largest banks are now shutting down retail gold trading for paper contracts. They are effectively forcing their citizens to hold the physical bullion rather than digital claims. These are the actions of a superpower prioritizing tangible reserves over financial instruments. By draining physical vaults while banning synthetic derivatives, China is positioning its economy to function on a foundation of hard assets rather than paper credit. This pivot away from paper began with a decision made in 1971, when Richard Nixon ended the U.S. dollar's direct convertibility into gold. This shift triggered securitization, a process where a nation's income starts to come from managing financial products rather than producing physical goods. For 50 years, the U.S. optimized for this system. We traded away our industrial base in exchange for a strong dollar that could buy cheap, imported goods from the rest of the world. This structural shift created immense wealth for asset owners and stockholders, but it ultimately left the national economy hollowed out. While software and toys became cheaper, the cost of everything that couldn't be shipped from a foreign factory, like housing and healthcare, skyrocketed. Now a new consensus is forming in Washington. Policymakers are calling for a return to Hamiltonian economics, using tariffs and subsidies to force factories and high-paying industrial jobs back to American soil. Rebuilding that capacity is a physical necessity, but the math of our current currency system makes it impossible to achieve. The U.S. is trapped between desiring industrial growth and the structural requirements of a strong dollar. This diagram represents the policy trilemma facing the U.S. Treasury. They are attempting to achieve 3 goals that cannot exist at the same time: rebuilding factories, protecting consumers on Main Street, and maintaining a strong dollar. If the government chooses to rebuild factories while keeping the dollar strong, American industry remains uncompetitive against cheap foreign labor. The only way to protect those factories is with massive tariffs. But those tariffs act as a tax on the public, driving up the cost of living and crushing the very consumers the government claims to protect. If they choose to keep the dollar strong and prices low for Main Street, they continue the status quo of the last 50 years. Cheap imports keep flooding in, and American factories never come back. The nation remains dependent on adversaries for the goods it needs to function. To achieve the 2 physical goals, industrial independence and stable prices, the government must eventually let the dollar's value drop. Reindustrialization requires a weaker currency to make American labor competitive again. Intentionally devaluing the world's primary reserve currency is a dangerous maneuver that threatens to destabilize global trade and destroy the savings of billions. To manage this transition, the system requires a neutral asset, one that no single nation controls, to absorb the value lost by the declining dollar and act as a highly stable reference point for global trade. John Maynard Keynes proposed a version of this in 1944, and China's central bank reiterated the need for a neutral reserve currency following the 2008 financial crisis to remove the deficiencies of debt-based national currencies. This historical theory is becoming current U.S. policy. Recent outlines from Treasury officials regarding economic statecraft echo these Hamiltonian principles, identifying physical gold bullion as the only tangible asset with the scale and history to settle global imbalances. For gold to perform this role, the math of global trade requires its price to be significantly higher than it is today. At $2,000 an ounce, the total supply is too small to settle the trillions in annual trade surpluses. This chart breaks down the requirement. When you take a trade surplus like China's, roughly $1.2 trillion, and divide it by their annual gold imports, the price where the math balances out is approximately $38,000 per ounce. This figure explains why central banks have doubled their gold buying pace over the last 3 years. They are accumulating an asset that they expect will function as the world's primary trade shock absorber in the coming decade. We are moving toward the end of the financial era that began in 1971. The system is transitioning away from a world where wealth is stored in the debt of a single nation. This suggests a long-term rotation of global capital. Wealth is already beginning to move out of financialized, paper-based assets and back into the physical world of infrastructure, commodities, and hard reserves. The shift toward a gold-backed trade settlement is a matter of mathematical necessity for any nation wanting to rebuild its industry. As the era of debt-driven growth reaches its limit, the world is returning to the only asset that has always been accounted for: